Thank you for joining us for our third quarter investment outlook. The title, Earnings Fuel the Rebound, could just as easily be replaced by more of the same, because that's what the second quarter was. More of the same, essentially a repeat of the first quarter, in which the major economies of the world continue to enjoy non-inflationary growth. And here in the US, investors did a great job of looking away from the daily barrage of political headlines and rather focused on the underlying economy, most important at this point in the cycle, earnings, which are growing for the first time in almost 3 years. By way of checking in and sort of a mid-year checkup of what we said at the beginning of the year, you may recall this picture from our 2017 Outlook pack, because at the beginning of the year, the major focus was on fiscal stimulus through increased spending and reduced taxes, what that would mean as far as fiscal stimulus and impetus for the economy and ultimately equity markets. And there were great expectations, as this title said. Because of that, at the beginning of the year, we saw a spike in growth expectations, inflationary expectations, interest rates, and the dollar. Now, you also may recall that we tried to temper those expectations by saying, though investors were expecting this, we thought it'd be more like this, given the political realities, and that's in fact what's happened. Right now, to prove the point, if you take a look at what inflationary expectations have done over the course of this year, you'll see they were trending up going into the election, spiked with the election, and then have essentially been working their way back to the starting point, back to the November 8 level. Essentially, the market discounted fiscal stimulus, and then that was removed from the market. We mention this because the point is, if we get some fiscal stimulus, we see that as a positive on the margin for the equity market. And if we don't get it, we don't see it as a negative because those expectations have already been removed from the market. Now, as growth expectations have been tempered and long-term interest rates have come down, that served to help weaken the dollar relative to some of the major economies in the world. On a trade-weighted basis, our dollar is down about 4.5% through the first 6 months of the year. Against the major trading partners, down 9% versus the euro, 2% versus the Chinese yuan, down 4% versus the yen. Now, these are pretty significant moves in a short period of time, and we mention this for two reasons. Number one, the impact on earnings. For the last couple of years, the dollar's been strong, and that's hurt earnings of the S&P 500 because 40% of revenues in the S&P 500 companies come from sales abroad. Now the wind is at the back of U.S. companies that are selling abroad and helping earnings on the margin. And number two, there are implications for U.S. investors investing abroad. It's been a great year for equities around the globe. If you take a look here, the blue bars indicate the returns in local currency. In other words, here in the U.S., U.S. investors through the S&P have returned 9.3%. In Japan, if you're a Japanese investor, you're up 5.8%. However, the green bars indicate the currency effect of a U.S. investor investing in these markets. Sticking with Japan for a minute, you get another 4% as a U.S. investor because the U.S. dollar has depreciated relative to the yen. So a total return to a U.S. investor investing abroad in Japan has been almost 10%. The big news, of course, has been emerging markets. They've done great, but international investing across the board has after underperforming last year and underperforming for the last decade, had a great run here in the first 6 months of this year, primarily buoyed by a weakening dollar. Now, if you look at Europe, for instance, the return in euros is 9.2%, almost the exact same return as the S&P 500. But as a U.S. investor investing in countries dominated by euros, you got another almost 9%, or a total of 18% return to a U.S. investor. So the weakening dollar has helped U.S. investors as they invest abroad. That's been a major theme. And of course, a market that isn't cheap. All economies in at least the major parts of the world have done well. Of the 30 largest equity markets in the world, 26 are up on the year. Almost half of those are at an all-time high. So equities aren't cheap. We talked about that at the beginning of the year. And our point was we're going to stay the course provided we can get earnings growth. And that's just what we've seen here in the first 6 months of the year. To that point, this chart indicates quarter by quarter the year-over-year change in S&P earnings. That's a mouthful, but essentially you can see here over the previous couple of years, earnings have essentially been flat on the S&P 500. Something certainly changed here in the first quarter of 2017 when earnings grew at almost 15% over last year's first quarter. Why did that happen? Well, for the factors that we talked about on the previous page. Number one, a weak US dollar helped foreign sales and foreign translation of sales abroad. And number two, some of the sectors that had been hurt in the last couple of years have started to rebound. We bullet pointed this here. Energy earnings are up 250%, financial earnings are up 11%, tech up 11%, of course the weak currency, not to mention a global economy that is getting healthier slowly, all serve to drive earnings growth. And the shaded bars indicate expectations for the balance of the year. Second quarter growth of 7%, almost 8%, third quarter, and something approaching 13% for the fourth quarter of this year. So we're going to keep a keen eye on this because, as we said, with a market that's trading at 19 times earnings, we're going to need this earnings growth to come through in order to justify these equity market levels. Now, in a market that isn't cheap, we try to find value, and a theme that we've focused on for the last couple of years has been the energy sector, specifically oil. Now, the energy sector, and oil in particular, is the simplest form of Econ 101. It's supply and demand. Anytime supply exceeds demand, prices go down. And when demand exceeds supply, prices go up. And to that point, the gray line here is taking a look at U.S. oil inventory. So what's the difference between supply and demand? Anytime supply is outstripping demand, inventories build. And there's a seasonality normally that builds until the summer and the driving months, and it goes down. But the point is this, that in 2017, you see that versus 2016, you see that supply was outstripping demand and demand was building. And since February, that's reversed, and demand has outstripped supply, and inventories have been coming down much more rapidly than they did this past year. And this is why we're optimistic that this is going to continue, and we're going to see inventory drawdowns, and we're going to see higher energy prices, specifically higher oil prices, as we progress into the back half of the year. And that's why we're maintaining our overweight to energy. Now, in a market that has seen interest rates near zero for almost 8 years, virtually no asset class is cheap or undiscovered. And to that point, we took a look at the major asset classes and where they're valued today relative to their range over the past 30 years. And the black diamonds indicate in that range where things are trading. And the one thing that stands out that is cheap relative to its past 30 years is commodities, particularly oil, and we're overweight there. But if you look at bonds, they're quite expensive, as you would think, with interest rates near an all-time low. The prices are high and therefore expensive. Real estate, again, not cheap. Towards the expensive end. In this environment, we favor direct investment over REITs. International equities are, in terms of equity classes, fairly cheap in that they're at the midpoint of the range. And here we favor emerging markets over developed markets. We're neutral on U.S. small cap, and in the large cap space that, again, trading at 19 times earnings is not cheap. We've tried to look for value, and there we've overweighted energy, financials, and healthcare. So again, in a market that isn't cheap, we're looking for relative value to exploit those opportunities. So to wrap up, we think we're going to continue to have sort of more of the same with a global economy that continues to slowly get better in a non-inflationary way. We think the Fed will keep tightening, but not enough to derail this economy. We're going to keep our eye on earnings because earnings are going to be the justification for maintaining this asset allocation, as well as the driver for higher prices for the stock market. And in terms of asset allocation, we continue to stay neutral in terms of our allocation to the major asset classes and dance close to the door, if you will. Thank you so much for your time and attention. We hope you have a great summer, and we look forward to catching up with you in the fall.